Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Friday, May 22, 2015. Inside the numbers tonight, we'll take a look at the SPY and the E-mini futures contract. Because the markets were so quiet today, we're going to do something a little bit different. We're going to deviate, and I'm going to give a little bit of lesson on cycles just for a second, just a 30,000-foot view, and how I derive the cycle that I think may be coming up. And it just gives you a bird's eye view into one of the tools I use in determining the cycles that I reference a lot of the time. We'll talk about crude oil, gold, bond market, and the U.S. dollar. So let's get into it. Let's go right over to the SPY chart. Here's a 60-minute chart. Let's start with the daily chart. And basically, you know, if you take a bird's eye view of the daily chart, there's nothing wrong up here. You can make a pretty good case that this is just going sideways, readying for another move higher, and that's certainly possible. You know, should we come down and work off some of this, you know, what could be conceived as overbought condition? Yeah, we might. But you have to keep in mind, like I said last night, the markets can remain overbought for longer than we think. And same thing on the downside. They can certainly go farther on the downside than we ever imagined they can. So there's a case for the bullish case, which I believe in longer term. And I don't mean longer term like years or anything. I just mean over the next several weeks to a month or two. But shorter term next week, we'll get into that with the cycles that I'm going to talk about in a few minutes. So let's just go over to the intraday chart, and let me give you a little picture of what happened at the end of the day. So this is a rollover, right? Last half hour of the day, we rolled over. What causes that? You know, I mean, it looks worse on this chart than it really is. I mean, it was only 4 or 5 points on the S&P, 40 or 50 cents. On the not even 50 cents on the SPY. So yeah, it was a rollover at the end of the day, but no, I wouldn't read anything into it, anything to take anything away from it. So let's kind of go over to a couple of other things. I really don't have anything new. I can't tell you that, you know, expect this on Tuesday. Although when we get into cycles, you'll see that that story may change a little bit, but nothing's really changed from last night. So let me just give a bird's eye view of a couple of other things before we get into the cycle work. Let me go back to my notes. Okay, so I definitely wanted to talk about a couple of divergences that I'm seeing out there. So one of them is the IWM, which is the small cap index, right? And this is 10 minutes. So let's go to the daily chart. And if you remember, I think I mentioned it last night, that you're not making new highs like you're making in the S&P and the Dow, right? So this is now a lagging index and, in my view, a lagging indicator, okay? So what you have here is a high, a lower high, and we're not sure whether this is going to be a lower high again, or this is going to consolidate and then move higher and challenge the highs at about 127. So that remains to be seen. But as of now, as it stands today, it is a inter-market divergence between the IWM small cap index, Russell 2000 index, and the S&P. Okay, a couple of other ones. Interestingly enough, let's take a look at Apple. And Apple's interesting because if the market's making new highs, and since Apple is the biggest, baddest stock out there, doesn't it stand to reason that Apple would be making new highs too? And if there was conviction buying in the market, wouldn't Apple be making new highs right now? I believe so, and it's not, right? So basically we have this U-shaped pattern here, and this is what I see, okay? We had a reversal day here, okay? We went up in the morning, made a high. This is an engulfing candle, and we finished near the lows, and then we proceeded down, and then we proceeded to move back up slowly and challenge this high. Now, very simply, if you can't take out this high at 134.54, then Apple's going to come back down, and in order to take out that high, now check this out. The volume that day was 119 million shares, okay? The volume today, which isn't representative, was 45 million shares. Today was obviously light volume, but even if we take another heavy day, 72 million shares, Let's take another heavy day, 51 million shares. So what I'm saying is, in order to bust through this high, I would think that the institutions have to dig in and get behind Apple and start buying with both hands. Otherwise, this is going to fail, and we're going to see another down move like this right here. Okay, so that's just something to keep an eye on. So that's another intermarket divergence. And Apple's a tech leader, and it's a market leader. It's the biggest stock in the world, so you would think that it would be leading, right? So let's take a look at another leader, which is Google. What do you see here? Same kind of routine. High, lower high. You challenged the high, you failed, came down, not making new highs. Let's zoom out a little bit and look at the weekly chart. You know, this is not necessarily a bullish pattern here. From a shorter term perspective, this may be considered bullish, but from a longer term perspective, I mean, you can't really see Google getting above, 600, even if it went on a run. How's it going to challenge these highs after this kind of a pattern, which is not a bullish pattern? It's not necessarily an uptrending pattern here. Okay, you're now stuck in between the 50 and the 20 period moving average on a weekly basis. On a daily basis, you just jumped over all the moving averages. The question is, can you sustain? We'll see. Time will tell. The next day or so will tell. And that was another interesting intermarket divergence that I thought was worth mentioning. Another one, and the last one we'll look at here, is, and they even started to talk about it a little bit on TV today, which I'm surprised at. They normally don't catch on to this stuff till after the fact. The transports, okay, the Dow Jones transports. Now look at this. Now obviously I've been doing some work on the transports, but if you go out to a weekly chart, okay, the transports are headed lower, okay? And what I've done here is, from this pivot low to the pivot high, I've drawn in a Fibonacci retracement. And what we have here is, looks like we're coming into the 618 retrace at 83.15. And today we closed at 84.32. So what I would suggest, and you can see, remember I talk about that symmetry, you see this down move, okay, and then this consolidation, and you can expect another down move about equal to the size of this week here, okay? And not from the next week, but from this pivot high. So let me do it for you. So the high was 91.42 and the low was 86.11. Okay, just for argument's sake, we'll call that a little over 500 points. Okay, and about 530 points. Okay, and if we take the pivot high here, which is 89.53, okay, and we take away the same 530 points, you come down in this neighborhood. It's a little higher. It's about 8,400 by the quick math. But nevertheless, that doesn't mean you can't reach 83.15. And by the way, as you get closer to the 618, the 618 will typically act as a magnet and draw price into it. And sometimes this is where you would get a price target from rather than support. In this case, I'm looking at this as going to be a price target. Okay? All right, so the point here is it's another intermarket divergence, certainly nowhere near making new highs. Airlines got clobbered this week. Just the transports have been weak, and in order for the entire global market to rally, right, or at least the U.S. markets, you have to have the financials, you have to have energy, you have to have the transports. You have to have market leaders like Apple and Google. And without that recipe, I would find it difficult to think that we're just going to take off from here. Okay, so that being said, let's just move on, and then I'm going to circle back. Let's go through some of the other markets, and I'm going to circle back to cycles, but we're going to run through the other markets real quick because there's not much to talk about. Very quiet day on Wall Street today. Let's go over to the The oil market, okay, so oil, same thing, right in the middle of our range, nothing doing, no new news. It was a down day followed, preceded yesterday by an up day, so we're just in the middle of the range, nothing's changed. We have to wait for some type of chart pattern to emerge that gives us an indication of what's next, and we just don't have it. So let's not waste time. Let's go over to the gold market. And gold stuttered today, didn't do anything. We're hovering around the 1205 area, this thicker purple line or lavender or fuchsia, whatever color that is. And, my better judgment based on my work, my analysis, and my experience tells me to expect higher prices into next week. But I don't know that we can get past the 1220 area, 1219, 1220, which is really in this 200 period moving average. So this would be the 200-day moving average. I don't know that we can get past this high here at 1225. I mean, it's possible, but right now I would have to see more on an up day. I'd like to see some follow through. We really haven't seen the type of follow through that I'd like to see in order to get really going on the upside. So that's where we stand, but I am looking for higher prices into early next week in the gold market. Okay, so let's go over to bonds. TLT today, flat, did nothing. If you look here, same picture, I'll just recap from last night. We had a really good low here. Where did we close today relative to the high here? 120.43. And we closed today at 120.40. We're still not in the clear. I want to see a close over this day here in order to say that we've got some follow-through coming on the upside. So nothing's changed from last night in the bond market. We're still in a holding pattern, but this low so far has hold. We'll see what Tuesday brings. U.S. dollar is had a nice up day today. It looks like it wants to make a run for the 20-period moving average, which is this blue line here at 96. It's going to probably pierce through it, maybe 97. But I'm still not sold that the entire down move is through. So I would actually like to see this get up to the 50-period moving average and see what type of reaction we have off of that. The next several days to couple of weeks off of that type of move would tell me whether we're going to move higher or whether we're headed back down lower. And really, it would be within the next few days from that event. So we'll see how that moves into the 50-period moving average and then make a determination from there. All right, so let's talk a little bit about cycles. I'm going to go back to the S&P. And cycles are interesting because it's not a science. It's more of an art form. And everybody can interpret cycles in their own way. And just like Elliott Wave, if you have 20 Elliott Wave analysts, you're going to come out with 21 potential results of what the next move is or the wave count. So it's not the same but similar. So when I use cycles, I don't use them alone to say here's what's next. I use them as a to augment what I'm doing, to complement what I'm doing with all the other chart work I do and all the other work I do to determine, when turn dates should come, how high prices should go, how low prices should go, all those factors that you hear me talk about time and time again. This is one of the things in the toolbox, and I can't explain the entire process of determining cycles in a couple of minutes, but what I can do is give you a snapshot of something I was looking at this week, and I just thought it was interesting, and I made a decision to tell you about it tonight only because, you'll see why when you see it. So what happens is, if you think about cycles like this, look at these this chart pattern here. You have an up move and a down move, an up move, a down move, an up move, a down move. So that could be determined. You could say that's a cycle from low to high to low. Could be a cycle from low to high. Could be a cycle or from high. From here from high to low to high. To low, or from high to high is a cycle, from high to high is a cycle, and all these are different. So a cycle may end and begin here and may come out with something in a future date And you may have another cycle because this is another important low that begins here and has another importance to a different date. And so what I'm trying to say is that when multiple cycles converge on the same day, that's when I deem them important. Could be a daily cycle, could be a weekly cycle, could be a monthly cycle, could be important numbers come up. So when those things converge on the same time period, I want to look closer at it and say, well, is there a reason why we should be looking for a turn in this period? Are we seeing highs? Are we seeing lows? So I did find something that I'll tell you about. So here's what it is. Here's what I have. So back in October 15th, okay, of 2014, you remember this low here. This was a big, big low. Look at this thrust off this low. That was an enormous rally. This is on enormous volume, and we just took off to the upside. And if you go to an important low, not necessarily the next, not necessarily the most important, but an important low, okay, which is February 2nd, okay? And in this area here, this is also an important low because you never breached it again, okay? So you came down, and then this was really like a test, and then you took off again, retested that, and took off again. So this would be considered another important low. So from the October 15th date to the February 2nd date, you have exactly 110 calendar days, not trading days. In this case, it's calendar days. Cycles can be determined in either way, and I do both, but this case is calendar days, okay? So keep that in mind. Why? Because from February 2nd here, the same 110 calendar days brings us to tomorrow, May 23rd, 2015, okay? So that's interesting. And that's important to note. Okay, let's just move on, and we'll go to the next one. Then we have February 26th. That is over here. Okay, February 26th, another important low. Okay, it's not the most important low. It's not the important low. It's an important low. Okay, and so February 26th, this is 2013, by the way. Okay. And I find another important low, okay, of April 11th, 2014, okay? And that would be over here, okay? Another important low, okay? Between those 2 days, February 26th, 2013 and April 11th, 2014 is a lot of time. It's 409 calendar days, okay? It doesn't have any significance in and of itself. But if I add 409 calendar days to April 11th, what do I get? I get May 25th. What's May 25th? May 25th is Monday, Memorial Day. Market's closed, but it's interesting. Okay, let's move on. Here's another one. December 31, okay, 2012. December 31, 2012. Where am I here? December 31, 2012. Here it is. Okay, an important low. Not the, but an important low. Okay? December 21, 2012. Another important low. I think it was a low. March 14th, 2014. Okay, here. No. Here. Okay? March 14th, 2014. Not the most important low, but a low, an important low, a low, a pivot. It's definitely a pivot, okay? Now, 438 days between those dates. If I add 438 days to March 14th, okay, what do I get? I get May 26th, Tuesday. Now, all these in and of themselves aren't the important lows, the most important anything. But remember what I said before. When I see multiple cycles converging, okay, now if I had a low from here that was significant because the prior low is the exact same time frame as the next low, which fell on Tuesday or Wednesday or something like that, I would have used this one, and this would be a very important low. But, well, we did have one. That was a different one. But the point I'm making is any pivot low that's a significant pivot low on a chart by itself, where you don't have to really, struggle to see it. This is a low, this is a low, this is a low, this is a low, this is a low. Okay, these pivots, can be meaningful if they converge with other ones. And that's the way I do some of my cycle work. And that's the reason why I wanted to bring this to your attention, is because I have 3 different cycles that are converging between this weekend and Tuesday. And to me, that's meaningful. And I don't know how it's going to play out. And maybe we just shoot up from here. Maybe because the market's been basically churning around and stalling and going sideways for the most part of late. Maybe at this point we just break up and we look for the melt up that I've been talking about. Or do we break down for a little bit a while, maybe just even a few days, maybe it's a week, and then we take off from there just to shake all the weak hands out, scare everybody off. Everybody's complacent right now. It's all giddy, and stock prices can only go up. There's only one place to put your money. It's in the stock market. I know all the stories. I know I have heard it all. But I'm looking at these cycles and I'm saying, to me, it's meaningful, but I can't say with conviction, here's what's going to happen. I can point it out to you and we can watch. And if we see some break, okay, then we kind of know that it's playing out and we can take advantage of it while it's happening. So that brings me to the last thing I'll discuss is, remember when I showed you this? I showed you this for a reason. The end of the day rollover today, is that going to be meaningful into next week? I don't know. It just struck me as interesting as I had those charts and the cycles on my mind. It's Memorial Day weekend. I think that's enough. Hopefully you're getting something out of these videos and you're learning something and it's been helpful in making some money for you. Have a great weekend, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.